Good morning and welcome to Charting the Markets on Wednesday, the 20th of September. Later on today, we've got the Federal Open Market Committee meeting and the rate decision by the US Federal Reserve, where we don't expect to see a rate hike, but the central bank is likely to give its economic projections, and these will be key to see whether rates will stay higher for longer. And on that worry, equity markets have actually come off since the beginning of this week, not just in the US, but also in Asia. And we saw that earlier this morning as well. Even though the oil price, which has risen by about 16% in the last 3 to 4 weeks, has started to come off as well ahead of today's US rate decision. In the United Kingdom, we had inflation come in at a weaker than expected level for August, with CPI inflation, that's consumer price inflation, hitting 6.7% year on year versus a forecast of 7% and a reading of 6.8% in July. And core inflation, excluding volatile items such as energy and food and tobacco prices, has also dropped to 6.2% year on year versus a reading of 6.9% in July. So that has actually given the European equity markets a boost earlier this morning. And we can see this here on the FTSE 100 daily financial bet, where we can see that we have bounced off the red line here, the 200-day simple moving average at 7,643, and are heading back up again towards the July high at 7,723 and also last week's high at 7,747. Now, these highs need to be taken out for us to be able to head up towards the psychological 8,000 mark, but the fact that we've bounced off and tested for 3 days consecutively the 200-day simple moving average and held there is quite encouraging for the bulls. So it is likely that at least short term we will see further upside ahead of tomorrow's Bank of England central bank meeting, where we expect to see another rate hike in the United Kingdom. Let's look at the European markets, and a proxy for these is the German DAX 40 contract. And here also we are seeing a slight recovery in this German stock index. Despite German producer prices, PPI coming in at a higher than expected 0.3% month on month in September versus a forecast of 0.1%. And here what we can see is that we're basically between a rock and a hard place between these two moving averages, between the red line here, the 200-day simple moving average at 15,563, and the orange one, which is at 15,895. That is the 55-day simple moving average. So here what we're seeing is basically a small bounce back, but we are just continuing to range trade as we have done since the end of August, and so far are holding above the 200-day simple moving average and also the August and current September lows. And this support area comes in between 15,563 and 15,469, and it is key for the ensuing trend over the next few weeks. Now, on the flip side, the key resistance area to look out for is the high seen back in August and also the current September high between 15,992 and 16,044. I expect further sideways trading to be seen here. We had last week, obviously, the European Central Bank hike its rates to 4%. And on the back of that, equity markets did come off a little bit. But at the moment, the DAX seems to be following more or less what US markets are doing. So let's have a look at those. And we can see here that the S&P 500 did decline earlier this week, and yesterday dropped even further to 4,416, a level last seen at the end of August, as there is a possibility of another US government shutdown being seen at the end of September. And obviously investors therefore remain cautious, because what we saw yesterday is that the Republican leaders cancelled a vote on short-term funding measures last night. And therefore we did dip down to 4,416 on the S&P 500, but in line with the stronger European session earlier this morning, we are currently bouncing back. Where's the resistance area here? Well, we've got the orange line, the 55-day simple moving average at 4,489, and also the 11th of September high at 4,491, which are short-term resistance and which need to be overcome for us to have an attempt of reaching Friday's high, which is key from a medium-term perspective at 4,516. So what I'm saying is that's the last reaction high. It's higher than the one that was made on Thursday and the one on Monday. And basically, if we were to rise and close on a daily chart closing basis above 4,516, then we could see further upside, perhaps take us back up again towards the July highs. But it's a big if, because right now, as you can see, we actually have a series of lower highs and lower lows. So short term, we actually, since the highs seen in early September, seem to be in a sideways consolidation phase with a bearish bias. And that means that if we were to fall, perhaps after today's Fed meeting, through the 4,416 low seen yesterday, we could actually retest the August low at 4,337. But very much will depend on the future guidance with regards to possible rate hikes by the Fed later this year, taking perhaps the Fed funds rates to between 5.5% and 5.75%. And obviously also the forecast with regards to what it sees for inflation and growth in the early part of next year. So we'll see what the decision is later on today. That is the key event in Europe and globally. Basically, everybody looking at what the Fed will say later on today, mainly with regards to further guidance. The US dollar, which has risen for 9 straight consecutive weeks, the most since 2014, had a negative impact on a lot of commodities. But I should have actually started with currencies, and I'd like to start with dollar yen. So yes, the US dollar and its impact on other currencies such as the Japanese yen. As we can see here, we are once again testing the highs we saw at the beginning of September. And if I zoom out on dollar yen, we can see that we're now trading at levels last seen back in October of 2022 at nearly 1-year highs and heading towards the psychological 150 yen mark. Now, that is an area where the Bank of Japan might actually intervene, as it has done in the past. So right now, traders are still willing to push the currency pair slightly higher, with the US dollar appreciating versus the Japanese yen. But you can see here the advance is very gradual. But we do hold so far above the July to September uptrend line. And basically, from a technical perspective, provided we stay above the last reaction low, that is to say the low from the 11th of September at 145.91, further upside may well be seen over the coming days ahead of the Bank of Japan's central bank meeting on Friday, where we don't expect it to hike its rates from its minus 0.10% rate at the moment. But perhaps the, again, further guidance with regards to future outlook and monetary policy might be interpreted as slightly being more hawkish, which could then lead to the Japanese yen appreciating again, and this currency pair here, at least short-term, topping out. But right now, the trend's your friend, that's still pointing higher for dollar yen. And the story is a bit different for the Canadian dollar, because what we saw here this week is Canadian inflation, I should say, rising in August to 4.0%, so much higher than the reading we saw around the 3% mark in July. And that has led to an appreciation of the Canadian dollar versus the US dollar. Short term, we have dipped down to 133.81. That was a low last seen about a month ago. And right now we are struggling with the 200-day simply moving average here in red at 134.62. Now, the trend's your friend again here. If we can't manage to stabilize around the current low we saw yesterday, then we could actually slide slightly lower and head back down again towards the 133 mark. So far, we're holding here around the early July highs, and seem to have found interim support there. So I wouldn't be surprised if over the next few days we could get a slightly higher reading with regards to dollar Canada. And this could be on the back of the Fed basically perhaps mentioning that there might be a possibility that it has to hike its rates further one more time this year. At the moment, I believe that market participants, according to the CME FedWatch tool, are expecting the Fed to hike its rates perhaps one more time. Not necessarily, traders are split on that, but we do expect the next rate cut to be seen only in June of next year. And only a few weeks ago, we expected it to happen already in May. So here for the currency pair, what does that mean? Well, if we were to bounce above the 200-day simply moving average with regards to dollar Canada, we have some minor resistance at 134.89, which is the early September low. And that is the next level. Then above there isn't really much resistance until the mid-August high at 135.75. So these would be short-term resistance areas. But I wouldn't be surprised that even if we were to reach these, we may actually come off again. As dollar CAD, as you can see here, once again failed in the 137, 136 area, as it has done back in April and also in May of this year. And each time we had this corrective move lower, and we're seeing one of those again at the moment. Euro sterling is kind of interesting as well, especially today, given the inflation rate in the United Kingdom, which came in lower than expected for the month of August. And what we saw was not just the headline inflation rate coming in lower than expected, but also the core inflation rate, which obviously is very important for the Bank of England. And on that news, perhaps rate hike expectations by some market players got lowered. And you can see here the effect of that is that euro sterling has risen to 86.59, a level last traded in mid-August, and is practically approaching the mid-August high at 86.69. That needs to be taken out for us to be able to retest the July high at 87.01, and also the red line here, the 200-day simply moving average at 87.13. But short term, as you can see here, we are bullish on euro sterling, and will remain so as long as last Friday's low, the last reaction low, which is seen at 85.70 underpins. The US dollar, as I was saying earlier, that has risen over the last consecutive 9 weeks, and that has had a negative impact on some commodities, whilst other commodities, such as sugar, for example, continues to rise to a near 12-year high. But before we talk about sugar, I'd like to very quickly mention the price of WTI, the price of crude oil. As you can see here on this daily financial bet, we have risen by about 16% to yesterday's high at $92.38 per barrel. From our late June lows, and now we are coming off that high ahead of today's FOMC meeting, even though we don't expect the Fed to hike its rates at this meeting. Maybe it's just some profit taking ahead of that event which is taking place. There is some minor support which comes in around the 5th of September high at $87.60. But before I mention that, what I would like to also talk about is the fact that we have stalled here at yesterday's high at $92.38, and that was marginally below the October and November highs, which were made last year between $92.48 and $92.95. So we've got some pretty good resistance here at the short-term end, capping the advance in the oil price. As you can see, we've risen for the last 3 consecutive weeks, and perhaps now we're just consolidating short-term in. And with regards to further support, the next support level would be the last reaction low, but that's a long way away, the 8th of September low at $85.74. So as long as that holds, basically this uptrend we've seen over the last few weeks very much remains intact, and further upside may well be seen with regards to the oil price, even though short term this week we may see a consolidation phase kick in. Sugar. I've mentioned sugar to you before. Sugar is trading at near 12-year highs and it continues to grind higher, as you can see here. So when you have these highs, what you can do is basically use a Fibonacci extension. What you do is you take an important move from a low, like we saw from the late June low. So we take that move to the high seen at the end of July. And then we take that distance and project it higher from the last reaction low, which is to say the late August low, and that gives us these projections. So 100% of that move came in around 26.74, and 161.8, which is a Fibonacci extension, comes in for this move at 28.86. So that is a potential upside target here for the price of sugar. And I said that we were trading in near 12-year highs. I actually need to go to a monthly chart to show you this. As we can see here, we're trading at 27.12. The next higher upside targets above the 161.8 Fibonacci extension I just mentioned would be the February 2010 high at 30.40. So that would be the next one. With regards to the price of number one sugar futures in New York. But as you can see here, we very much remain bullish, provided we stay above the last reaction low. That's Monday's low at 26.71. Last but not least, I'd like to mention lumber. We don't often talk about lumber, but you can see here front-month lumber futures have now fallen through their early August lows and are heading down towards their June lows. And those were made at 49,170.4 for the futures contract. And that is key support together with the March low, which came in slightly lower at 49,144.7. So this is the downside target area for the price of lumber. But as you can see, lumber prices have declined very sharply over the last few weeks since the July highs that we saw. And it looks as if further downside is very much in store for this commodity as well. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X, formerly known as Twitter, and my handle is @AxelR_IG.